Mortgage rates have gone up while interest rates fell late last year. Can you explain to folks looking to buy a house why that is and what would it take to get some relief?
Yeah, that is a very good question, and it's a little complicated, so bear with me. But like, if we look at mortgage rates, they tend to be most tied to the longer end of the yield curve. So we think about the Fed, and what they do in their meetings on a regular basis is adjust the federal funds rate, which is most tied to the shorter end of the yield curve because it's an overnight rate. So if you look at something like um, a short term, like a 3-month treasury bill, that's obviously going to correlate very highly with the federal funds rate. It's going to move in lockstep with it. But if we look at something like the 10-year treasury yield, it can very often move in the opposite direction as the federal funds rate. And the 30-year mortgage rate tends to correlate most tightly with the 10-year treasury yield. So the 10-year treasury yield increased from kind of a near-term trough of around 3.6% back in September 2024 to, as of today, standing at about 4.6%. So that's been a 100 basis points increase over the same period that the Fed has reduced interest rates. And so because of the 30-year mortgage rates ties to the 10-year treasury yield, it's followed it upwards. And so that's why mortgage rates have increased. Now, as far as why the longer end of the yield curve has increased at the same time that the Fed has been cutting, well, that's because the longer end of the curve is more so driven by expectations of where the Fed funds rate is going to go over the next 1 to 2 to 3 years and beyond, as opposed to where it is right now or where it's going in the very near term. So because the market has trimmed its expectations of future Fed rate cuts, longer term yields have risen, even as the Fed has been engaged in the actual process of cutting.